And that's, of course, the domestic picture. But I want to switch back to global. And I want to quickly take you through what's played out. One, you're seeing Brent again above and firmly above the $100 a barrel mark. Brent is now firming up around the $105 a barrel mark, 3.5% uptick on Brent that we're seeing overnight. We're also seeing US markets which notched all-time highs on Friday. In fact, I believe the S&P 500, the Nasdaq, both of those clocked their all-time highs, closed at their all-time highs. So those two markets, or rather those two indices in particular, are driving US markets higher in general. So that's the other piece that's played out. Bond yields, we're seeing a bit of a spike overnight on the US 10-year. We're seeing the US 10-year now at 4.39%, around a 2 to 3 basis point spike on the US 10-year bond yield is what we're seeing overnight. And Asian markets are reacting to China's CPI numbers, which have come through. And what we're seeing on the numbers is a slight negative bias to the numbers that are coming through, as a result of which you're seeing those reactions on the street. Let me bring on board Ed Yardeni as well, President and Chief Investment Strategist at Yardeni Research, joining us. Ed, how do you reconcile these? Oil prices continue to be elevated. You're continuing to see large amounts of uncertainty. You have the US president passing comments as well overnight. But US indices brushing all of that off. In fact, even the US futures not really indicating anything materially negative. Just a slight negative bias is what US futures is currently showing.
Yeah, you're right. I mean, it's been extraordinary to see the strength of the global stock market rally continuing here, only with a kind of a brief sell-off during March. But ever since the end of March, it's been up and away, particularly in the United States, but also in many other areas of the world. I think part of the answer here is that this is not the 1970s all over again. The world is much less energy intensive than it was a few decades ago. That's part of the answer. I think the other is oil is leaking out of the Persian Gulf one way or the other. Maybe a good part of it's coming out of the pipelines out of Saudi Arabia. But probably the most important development is the United States, I think, is basically looking the other way and allowing Russia to sell a lot of oil to China and India. And I think that's making a big difference here in keeping the price of oil down. Other than that, of course, inventories are being drawn down in strategic petroleum reserves. But the market knows all that, and even the oil market has been, it's been elevated, but it's right around $100 a barrel. And I think the stock market's saying that the global economy can live with that.
Ed, I think the one market which is really catching everyone's attention has been South Korea. I mean, record high after record high. That's what, some of these tech play earnings can do. I mean, and I wonder why you're seeing so much of money actually gush into markets like South Korea.
Well, look, I think we're in an AI-led melt-up in some of these global stock markets, particularly in South Korea, where there's a couple of companies that are very important in terms of producing memory required for AI infrastructure. Taiwan, of course, has Taiwan Semi and other important companies for the AI approach. In the United States, of course, we have a lot of companies. That's no longer just the Magnificent Seven. There's also all the semiconductor companies that are not in the Magnificent Seven that are doing extremely well. So earnings have been remarkably strong during the first quarter earnings season that is just about coming to an end in the US. And earnings have been very, very powerful. And analysts have just been, I've never really seen anything like it, where analysts are raising their earnings estimates so rapidly for each quarter of this year, and for next year. And so again, I think we have what I would describe as an earnings-led melt-up, which may be more sustainable, but it also may be too much of a good thing.
How do you look at fund flows in the entire context? Then do you see funds now or foreign flows now going into these markets where you have the AI play and avoiding other emerging markets where you don't have that AI?
Well, I have been recommending overweighting the rest of the world relative to the U.S. Since 2010, I'd been recommending staying home in the U.S., in other words, overweighting the U.S. That worked out really quite well. And then last year, we saw a reversal where the global economy's stock markets were doing much better. And I think that'll continue. And I think emerging markets, including India, should benefit from it. But of course, what's really driving the emerging markets indexes up right now, as we just discussed, is South Korea and Taiwan. Their stock market, even little Israel's stock market has been very strong because it too has a presence in technology. Brazil, Mexico, they've done well for various reasons. Mexico has oil, Brazil has some key commodities. But with regards to India, I think the main issue is the price of oil. And it's too high right now and it needs to come down. So I think India doesn't necessarily participate in the emerging markets rally, which is not across the board. So India is not exactly all by itself, but it is an oil importer. And I think oil importers are at a disadvantage here as long as the Strait of Hormuz is closed and oil prices remain at $100 and people fear it could go higher.
Indeed. Ed, always good having you on the show. Thank you so much for your
Thank
time
you.
today.
My pleasure.
Okay.